If you look at the official macroeconomic data right now, the United States economy looks strong. GDP is growing, stock markets are near historic highs, and aggregate consumer spending remains robust. But the University of Michigan Consumer Sentiment Index just fell to 47.6, the lowest level in the survey's 74-year history. That is worse than the 2008 financial crisis, worse than the pandemic, worse than the 1980 energy crisis. The explanation lies in a single statistic. The top 10% of earners now account for nearly 50% of all consumer spending in the United States. In this video, we'll break down how the American economy became so dangerously dependent on a fraction of its population and what happens when that fraction stops spending. To understand what is happening, you have to understand how macroeconomic averages can be deeply misleading. Personal consumption expenditures account for roughly 68 to 70% of U.S. GDP, the highest share in decades. When economists report that consumer spending is growing, they are reporting an aggregate number, but that aggregate is being driven overwhelmingly by one group. According to Moody's Analytics and Bloomberg, the top 10% of earners, households making at least $251,000 a year, account for approximately 49.7% of all consumer spending. The top 1% alone hold $55 trillion in assets, roughly equal to the combined wealth of the bottom 90%. Here is why this matters. If one person buys a $500,000 car and 99 people buy nothing, average consumer spending still goes up. GDP still grows, the aggregate number looks fine, but the reality for 99 out of 100 people is that they bought nothing. This is not a hypothetical. Bank of America Institute data from late 2025 shows spending growth for high-income households running at about 3% year over year, while spending growth for lower-income households was less than 1%. 62% of employed Americans report that their income has not kept up with household expenses. The traditional metrics are capturing the spending of the wealthy and presenting it as national prosperity. So, why is the gap this wide? The root cause is what economists call a K-shaped economy, where two populations experience fundamentally different economic realities depending on the source of their wealth. The top 10% derive their wealth primarily from assets, stocks, real estate, and business equity. The typical stockholder in the top 10% saw their equity holdings grow from $624,000 at the end of 2022 to $1.1 million by the third quarter of 2025, a 76% gain in under 3 years. The bottom 90% derive their wealth from wages. And real wages for low-income workers actually declined in 2025, according to the Economic Policy Institute. Keep in mind that high interest rates make this asymmetry worse, not better. High-yield savings accounts are paying up to 5% APY, generating passive income for people who already have large cash positions. Meanwhile, the average credit card interest rate is 21 to 22%, and total U.S. credit card debt hit an all-time record of $1.28 trillion in the fourth quarter of 2025. Americans are accruing an additional $368 million in interest every single day on credit card balances alone. The same monetary policy is enriching one group and crushing the other simultaneously. Corporations have noticed this bifurcation and they are responding rationally. The strategy is called premiumization, where companies abandon the middle market to focus on luxury and high-end consumers. Ford discontinued the Fusion, Fiesta, Focus, and Taurus to concentrate on high-margin SUVs and trucks. Airlines are expanding premium cabin capacity while reducing economy-class comfort. The average new vehicle transaction price exceeded $48,000 in 2025, effectively pricing out a large portion of the middle class. Even the global luxury market is narrowing its focus. The luxury customer base shrank from 400 million in 2022 to approximately 335 million by early 2026. Rather than lowering prices to recapture those 65 million lost customers, luxury brands doubled down on scarcity-driven strategies targeting only the ultra-wealthy. The free market is efficiently allocating resources, but it is allocating them exclusively to people who still have money. This creates a structural problem that should concern everyone. If the top 10% account for half of all consumer spending, the entire economy becomes acutely sensitive to asset prices. Goldman Sachs estimates that a sustained 10% equity market decline could subtract half a percentage point from GDP growth. A 20% drawdown could reduce growth by nearly a full percentage point. Under normal circumstances, when wealthy consumers pull back, the rest of the population cushions the blow, but the bottom 90% have no cushion left. The personal savings rate sits at 4.5%, barely half the historical average of 8.4%. Credit card delinquency rates have climbed to 7.113%. Moody's Analytics currently places recession probability at 48.6%. As far as I can tell, the economy is not strong. It is narrow. A dollar spent by a billionaire counts the same as a dollar spent by a school teacher on a spreadsheet. But an economy where half the spending comes from 10% of the people is not resilient. It is brittle. The middle class is not disappearing because they are getting rich. They are disappearing because the cost of participation has outpaced their wages, and no one in a position to change that has any incentive to do so. Alright guys, that wraps it up for this video. What do you think about the concentration of consumer spending in the US economy? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one.